In 2019, WeWork looked like one of the most important companies in the future of work. It had glass offices in major cities, startup founders in hoodies, enterprise clients, global expansion, and a private valuation that reached $47 billion. To a customer, WeWork felt simple. Open the app, choose a location, walk into a beautiful office, and start working. But inside the business, the simplicity was hiding a much harder question. What if the company selling flexibility was the least flexible player in the room? WeWork was founded in 2010 by Adam Neumann and Miguel McKelvey after an earlier co-working concept called Green Desk. The idea was powerful because it attacked one of the most annoying parts of building a modern company: office space. Traditional office leases were slow, expensive, and rigid. A startup might not know how many employees it would have in 6 months. A freelancer might want a professional place to work without signing a long contract. A company entering a new city might need space immediately before committing to a permanent headquarters. WeWork offered an answer. It leased large office spaces, redesigned them, furnished them, added services, and sold access to smaller teams through memberships, private offices, and flexible agreements. The customer did not have to negotiate with a landlord, hire contractors, buy furniture, set up internet, manage cleaning, or guess the future size of the team. That was the original insight. WeWork did not just sell desks, it sold time, convenience, image, and reduced commitment. And at the time, that was not a foolish thing to sell. The 2010s were built for this pitch. Startups were raising money quickly. Freelancers and independent workers were growing as a visible part of the economy. Tech companies wanted offices that felt more like culture than infrastructure. Even large corporations were beginning to experiment with satellite teams, project spaces, and more flexible real estate. In that environment, WeWork's decisions made sense. If customers hated long leases, someone had to absorb the lease and make the product flexible. If office space was boring, someone could turn it into a brand. If small companies wanted the feeling of a bigger company, WeWork could give them reception areas, meeting rooms, coffee, events, and a professional address from day one. The company also understood something traditional landlords often missed. For many customers, the office was not just square footage. It was a recruiting tool. It was a signal. A young company in a beautiful WeWork could look more established than it really was. A remote worker could leave the kitchen table and join a place that felt energetic. A corporate team could enter a new market without building a whole office from scratch. That is why the Empire was not built by accident. WeWork took a dull, slow, contract-heavy industry and made it feel immediate. The business model also had a logic. WeWork could lease a large floor at one price, redesign it, divide it into many smaller units, and charge a premium for flexibility and services. If enough desks and offices were filled, the building could become a strong cash-generating asset. At high occupancy, the same space that looked expensive could become efficient. From inside the company, speed also looked rational. In real estate, the best locations matter. Once a competitor locks up a great building in New York, London, San Francisco, or Tokyo, you cannot simply copy that address. The market was rewarding category leaders, and WeWork wanted to become the default global name in flexible workspace before anyone else could. Every new location made the network more useful. A member in one city could use WeWork in another. A startup could expand from 5 people to 50 without leaving the system. A corporation could test new teams without committing to a traditional office. Scale was not just vanity, it improved the product. Then came the bigger validation: enterprise customers. WeWork was no longer just a playground for freelancers and early-stage startups. Larger companies began using it for overflow space, temporary offices, hybrid teams, and expansion. That mattered because enterprise demand made the model look more durable. If major companies were buying flexible space, then WeWork was not just chasing a trend. It seemed to be moving ahead of a real shift in how companies thought about offices. By 2019, the company had hundreds of locations across more than 100 cities. The brand had become almost synonymous with co-working. And to investors, the story was intoxicating. WeWork was not just renting offices. It was presented as a platform for the future of work. That framing changed everything. A normal real estate company is judged by occupancy, rent, debt, cash flow, and disciplined expansion. A technology platform is often judged by growth, network effects, market capture, and future potential. WeWork lived somewhere between those two worlds, but its valuation increasingly depended on the second one. Again, the logic was understandable in the context of the time. Private markets were rewarding companies that grew fast, captured users, and dominated categories before profits arrived. Uber, Airbnb, and other platform businesses had trained investors to accept heavy losses if the company could become the central layer of a massive market. So when SoftBank poured billions into WeWork, the money did not just fund offices. It reinforced the idea that this was a once-in-a-generation land grab. If WeWork could become the operating system for office space, then losing money during expansion could be framed as investment. But the strength of the model also created its weakness. To give customers flexibility, WeWork had to take the opposite side of the deal. Customers could come and go. WeWork could not. Customers could reduce space quickly. WeWork still owed rent. Customers could treat the office as a service. WeWork had to carry the building like a long-term obligation. This was the hidden mechanism. WeWork sold short-term freedom by buying long-term risk. That did not automatically make the model bad. Hotels do a version of this. Airlines do a version of this. Many businesses with fixed costs can work if demand is steady, pricing is strong, and utilization stays high. But WeWork was scaling those fixed commitments extremely fast before the company had proved that the economics could survive a downturn. A beautiful office at 90% occupancy can look brilliant. The same office at 60% occupancy can become a rent bill with plants, sofas, and free coffee. The problem was not visible in the brand. It was buried in the timing of cash. A new WeWork location required lease commitments, renovation costs, staff, services, and time before it reached maturity. Growth created revenue, but it also created more obligations. As long as capital was available, the company could keep expanding and tell a story about the future. But if investor confidence slowed, WeWork would have to live with the leases it had already signed. The 2019 IPO process forced that reality into the open. When WeWork prepared to go public market investors could finally inspect the machine. They saw fast revenue growth, but also deep losses. They saw a famous brand, but also enormous future lease commitments. They saw global ambition, but also governance concerns around founder control, related party issues, and strategic sprawl beyond the core office business. This was the first point of no return. The failed IPO did not mean nobody wanted WeWork's product. It meant public investors were not willing to value the company like software while its obligations behaved like real estate. Once that difference became visible, the $47 billion story could not hold. Adam Neumann stepped down as CEO in 2019, and WeWork tried to rebuild under new leadership. The company cut costs, refocused on the core business, and later went public through a SPAC in 2021 at a much lower valuation. Even that move had a rational argument behind it. After the pandemic began, companies were questioning the old office model. Nobody knew exactly how much office space they needed anymore. In theory, that uncertainty should have helped WeWork. If businesses wanted less commitment, flexible workspace could become more important. But that was the cruel twist. The market was moving toward the idea WeWork had been selling, while the company was still burdened by the structure it had built to sell it. COVID and hybrid work did not create WeWork's weakness. They attacked it. Office demand became less predictable. Some customers reduced space, some delayed decisions. Some companies discovered they could operate with fewer people in the office at the same time. Landlords, tenants, and employers were all trying to understand a new reality, but WeWork still had to carry the old one. Large portfolios, fixed rent, and locations that needed occupancy to make sense. As interest rates rose and investor patience for unprofitable growth faded, the environment changed again. The same strategy that had looked bold in the cheap capital era now looked dangerous. Expansion was no longer automatically rewarded. Cash discipline mattered. Profitability mattered. Lease exposure mattered. By 2023, WeWork was no longer fighting a narrative problem. It was fighting a balance sheet problem. The company could improve operations, sell memberships, and negotiate with landlords, but the old commitments were too heavy. Chapter 11 bankruptcy became the tool to do what ordinary operations could not: cut debt, reject or renegotiate leases, and resize the company around reality. In 2024, WeWork emerged from bankruptcy after eliminating billions in debt and reducing future rent costs by more than $12 billion. The company expected to keep operating hundreds of shared office spaces, but the empire was no longer pretending to be a hyper-growth technology platform. The second version of WeWork became more disciplined, more real estate aware, and more focused on reducing risk. Under new leadership, the company began emphasizing management agreements, revenue shares, and landlord partnerships. That matters because those structures change the risk. Instead of WeWork taking the entire rent burden alone, the landlord may share more of the upside and downside. That is not as glamorous as saying you are reinventing the world, but it is closer to the business WeWork probably needed to be. And that is what makes the story useful. WeWork was not simply a fake company. It solved a real problem. It built a real brand. It found real demand. It understood, earlier than many others, that companies wanted office space to be more flexible. The mistake was assuming that being right about the customer would make the business structure safe. For a while, every signal seemed to support the next aggressive decision. More members validated more locations validated more capital validated a higher valuation. A higher valuation made caution look like weakness. But underneath that momentum, the company was making a trade. It gave customers freedom and kept the obligation for itself. That trade can work at the right scale, with the right contracts, in the right locations, with the right cost structure. But WeWork scaled it as if growth itself would solve the risk. It did not. The lesson of WeWork is not that flexible offices failed. The lesson is that flexibility has to exist inside the business model, not just inside the product. A company can sell freedom to its customers and still build a prison for itself.